Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows for the week ended Wednesday, October 22nd, 2014. I don't think anybody will be surprised with the notion that people were putting money to work this week. We had about $14.6 billion enter the conventional fund business, but really what it's going to turn out to be is almost all of it went into money market funds. You know, we had some good news, and actually it was the fourth week in 5 that we've actually seen inflows into the group, but what we had is 4 days that were just really strong, followed by some consolidation. People got a little bit nervous, took some money off the table after seeing quite a few good indicators this week. Actually, we had a non-voting member of the Fed actually come out and say, hey, you know, we might extend, our bond buying, bond purchases a little bit longer. And that's later on came out that they probably aren't going to do anything like that. But certainly we've had some news there. Also, we, other than talking about extended bond purchases, we had some really good news. Earnings have been very strong. Actually, we're right around the 70% range for S&P reporters coming in, beating expectations. Consumer sentiment hit a 7-year high. And we also saw that in September, new home construction actually rose about 6.3%. So really, overall, it was just really, really good news. And we also heard this week that the S&P 500 actually had its largest one-day increase this year. Well, we really didn't have the numbers that panned out on this because people have remained very nervous about political uncertainty and all the volatility out there. Let's see how this news panned out to flows for the conventional fund business. If we take a look in our macro group, we see equity funds took in about $1.1 billion, so that's a good number. Taxable bond funds took in about the same, about $1.1 billion. Muni bond funds actually were negative for the first time in many weeks, but again, to the tune of about $7 million. That's a rounding error. It's probably better just to say zero and not paint that orange. But that's kind of the way the numbers come out. But where the big money went into, and again, people sitting on the sidelines, $12.4 billion entered the money market arena. And again, investors have been a little bit nervous about entering the market. And we've had just so much volatility, so many losses, getting close to maybe even a 10% correction in the equity market, certainly 10% in the Russell 2K area. So small caps have been getting crushed. People just really don't know what to do. So they're sitting back this week, especially waiting for the Fed. We're right now in the blackout period for the Fed. Next week, the Fed will be meeting again just to see what they're going to be saying as well. Well, let's see how this panned out to the individual macro groups. Let's take a look at equity funds. For equity funds, we see that they actually took in about $1.1 billion. Like I said, it's the second week in 3. We've seen positive flows into that group. 2.99% return. This is the second week in 3 that we've actually seen returns in the positive side, but this has actually been the best 1-week return we've seen since February. Great number. How this broke out is a little bit different than what we've been seeing recently. Basically, we saw domestic equity funds taking about $1.3 billion. First week in 9, they've seen some inflows. Non-domestic equity funds, which has actually been usually taking in money, saw negative flows. About $0.2 billion exited their coffers. This is the first week in 3 that we've seen negative return, or I'm saying negative flows from that group. So that was kind of a change in pace. What we saw is large cap funds took in about $900 million of net new money. Global equity funds also took in about pretty close to, I'm going to say $700 million, somewhere in that area. It's actually like 694, but $700 million. And then we saw that on the international equity side, that's where we saw some big outflows. We saw about $900 million exit their coffers. So really it was just kind of a change of pace. Again, people still concerned globally, maybe putting a little bit of money work back to large caps, maybe some safety issues. We also heard just late in the month or late in the week that people were actually going after utilities and some safe haven plays as well. Let's go ahead and take a look at what happened on the ETF universe. Big difference there. We saw a lot of outflows. Second week in 3 that we've seen outflows. $9.2 billion exited the coffers of this group. And at the top of the inflows, we saw basically the iShares real estate fund take in about $700 million. The iShares core S&P 500 also took in money, about $600 million. But on the bottom of this graph, you can see Spider S&P 500 lost about $6 billion. It's a huge chunk of change to be handing back. And the ProShares QQQ saw about $1.2 billion in net redemption. So we saw a lot of big swings, a lot of big moves, a lot of big bets going on in the ETF universe. It really was countervailing or opposite of where we saw retail investors putting their money to work. Let's go ahead and take a look at fixed income funds. We actually saw a big change there. This is the 11th consecutive week that we've seen inflows, and $1.1 billion went into the conventional fund business via the fixed income group, and it's the second week in 3 that we've actually seen a plus side returns. About 0.58% return. That's a huge return for a weekly return. Remember, that's what we're talking about. Here's where the change was. We saw high yield funds actually take in the lion's share of money. About $0.9 billion came into that group. Again, a little bit under $900 million. The second week in 3, we've actually seen high yield funds taking money. And then if we take a look on the international global group as far as taking in money, they took in about $500 million. And this is the 6th week in 7 that we've actually seen them taking in money. And on the flip side, where we've actually seen some other areas actually take in money, really the safety area, remember, we're concerned. This week, really great week, but still people being very concerned. Government treasuries actually saw the biggest redemptions. About $300 million exited their coffers. Well, let's take a look at what happened on the ETF side of the fixed income equation. Big money came in, $5.1 billion came into the ETF fixed income space. It's the second best inflow that we've seen since we've started tracking fixed income ETF flows on a weekly basis. This is the 3rd consecutive week, though, that we've actually seen inflows. So it's really been a grand week for fixed income ETFs. How this panned out was iShares 1 to 3 Treasury Bond Fund again saw about $2 billion net new money come into their group. iShares short-term Treasury Bond ETF took about $1 billion. So we see the short terms actually taking it in. Makes a lot of sense with this volatility, not knowing where the Fed is going to go with their policies, and people are just making better short-term bets. On the flip side, we saw PIMCO 0 to 5 year high yield actually hand back the biggest amount, about $400 million went out of their coffers and into investors' hands out of that group. Well, let's take a quick look at muni bond funds, and this is something that's changed. We actually, for the first week in 11, we've seen net redemptions. It was only about $7 million, so as I said, really maybe even just a rounding error. It's the first week in 5, though, that we've seen negative performance, 0.59% loss. That is a big loss for munis. Nothing really big in the news. National munis lost about $4 million, and this is the first week in 15 that they've seen net outflows. So that was quite a change as well. Well, that brings us to our last macro group, and that's money market funds. Money market funds, once again, took in the largest share. About $12.4 billion came into that group. It's the 4th week in 5 we've seen positive inflows. And as we take a look at it for the breakout, taxable money market funds took in about 12.7 of that. Institutional money market funds took in $8 billion versus the retail taking in about 4.7. On the other side of the fence, tax-exempt money market funds, we actually saw a slight outflow. About $300 million was returned to investors out of that group. Now, as we get towards the end of this presentation, obviously there's some concerns. We heard about it this morning, actually late last night, that there was a doctor who came back from treating patients over in Africa and became positive for Ebola. And that certainly put a lot of people back on their heels. It really didn't impact the market so far, as people are waiting to see if it spread any place. Certainly that's the concern, though, is a big metropolitan area like New York. To have somebody come back with a positive virus certainly has some concern. But I think what other people are looking at is the positive economic news that we've got this week. Also, great earnings reports and earnings news coming out for this week and next week should really help us tie in what profits we're going to be looking at. So I think it's really up in the air. I'll be curious to see what happens by next Wednesday as far as flows goes. So far, so good for the first 2 trading days of this week. And I'm talking Thursday and Friday because our flows are Wednesday to Wednesday, but certainly that's what I'm going to be looking forward to seeing is how investors respond to this most recent threat and also some good news that's on the table. Well, if you want to do a deeper dive into some of the data I've been talking about, you can go to our website at www.lipperusfundflows.com. If not, you can join us next week where one of our analysts will talk to you about the current week trend. Well, thanks for joining me. My name's Tom Rosine, wishing you the best in your wealth planning and creation.